You know you should be investing. You've known for months, maybe years. You've watched the videos. You've read the articles. You could probably explain compounding interest to someone at a dinner party, and yet your investment account is still empty, or it has $200 in it from that one time you actually followed through, and then you stopped. Not because you decided to stop, not because something went wrong. You just didn't continue. The tab stayed open. The intention stayed alive, but the action never happened, and you feel guilty about it. That quiet, nagging guilt that whispers every time you see a financial headline or hear someone mention their 401k. I should really set that up. I'll do it this weekend. Next month for sure. And next month becomes next quarter, becomes next year, becomes 5 years of knowing exactly what to do and not doing it. Here's what nobody tells you. That pattern, knowing and not doing, is the single most expensive financial behavior in existence. It's not debt. Debt is expensive, but debt is visible and it has a clear solution. It's not overspending. Overspending is damaging, but at least the money went somewhere. Financial procrastination is worse than both because it produces nothing. No asset, no experience, no benefit. Just the invisible, silent, compounding cost of time that you can never get back. The number one wealth killer isn't something you do. It's something you don't do, and it costs the average person between $300,000 and $600,000 over a lifetime. Today, I'm going to show you exactly how that cost accumulates, why your brain is specifically designed to procrastinate on finances, and the one structural fix that defeats procrastination permanently. My name is Max, and I want to help you learn how to make your money work more for you in your life. This channel is about diagnosing the real obstacles to building wealth, not the obvious ones everyone talks about, but the hidden ones that silently drain hundreds of thousands of dollars from your future. If that resonates, subscribe, because this might be the most important financial video you watch this year. So here's what most people think when they hear wealth killer. They think debt, they think bad investments, they think overspending, and those are all real problems. But when researchers at the National Bureau of Economic Research studied the factors that most strongly predict retirement preparedness, the single strongest predictor wasn't income, wasn't debt level, wasn't investment selection. It was the age at which someone started investing. Timing beat everything. And the biggest timing failure, and the one that costs the most over a lifetime, isn't starting too late because you didn't know better. It's starting too late because you did know better and didn't act. That's financial procrastination, and it's epidemic. Surveys consistently show that 60% of Americans who don't have retirement accounts say they plan to start one soon. They plan to start one soon for an average of 3 to 5 years. That's 3 to 5 years of compounding that vanished. Not into bad investments or unnecessary purchases, but into nothing. Into the gap between intention and action. Let me show you the cost of that gap with an analogy. Imagine two identical conveyor belts in a factory. Both belts run at the same speed and produce the same output per hour. Conveyor belt A starts running on January 1st. Conveyor belt B starts running on January 1st, 5 years later. Same speed, same output per hour. But belt A has a 5-year head start. By the time they both shut down in 30 years, belt A has produced roughly 40% more output than belt B. Not because it was faster, but because it started sooner. Your investment account is a conveyor belt. Every month it's running, it's producing returns that compound on previous returns. And every month it's not running, every month you procrastinate, is production that's permanently lost. You can't go back and start the belt 5 years ago. Those 5 years of compounding are gone forever. But here's where it gets really interesting, because the cost of procrastination isn't linear. It's exponential, and the longer you wait, the more each additional month of delay costs. The psychology of financial procrastination is specific and well documented, and it's different from general procrastination. You don't procrastinate on paying rent because the consequence is immediate and concrete. You don't procrastinate on buying groceries because hunger is a powerful motivator. But you procrastinate on investing because the consequence of not investing is invisible, abstract and far away. Your brain literally cannot feel the cost of financial procrastination the way it feels the cost of missing rent. And because the cost is unfelt, the urgency never materializes. Psychologists call this hyperbolic discounting, the tendency to prefer smaller, immediate rewards over larger, delayed ones. But with financial procrastination, it's even more insidious. You're not choosing a smaller reward over a larger one. You're choosing no effort now over massive reward later. And because no effort feels like nothing, it doesn't register as a decision at all. You didn't decide not to invest. You just didn't decide to invest. The absence of a decision feels neutral, but financially, the absence of a decision is catastrophically expensive. There's another layer too. Financial procrastination is often driven by perfectionism, the belief that you need to understand everything before you start. I should learn more about index funds. I need to figure out the best brokerage. I want to understand the tax implications. Each of these sounds responsible. Each of them feels productive. But each one is a delay mechanism disguised as diligence. Because the difference between the perfect investment strategy and a simple, imperfect one is a few percentage points at most. But the difference between starting and not starting is hundreds of thousands of dollars. Imperfect action crushes perfect inaction every time. I want to be specific about this because it matters. Let's say you spend 2 years researching the best investment approach and then invest in a portfolio that returns 9% annually. Meanwhile, someone who spent 15 minutes setting up a basic index fund 2 years ago has been earning 8%. The perfect portfolio earns 1% more per year. But the imperfect portfolio had 2 years of compounding head start. On a $500 per month contribution, those 2 years of head start are worth approximately $13,000 by year 20. The 1% annual advantage from the better strategy, it's worth approximately $12,000 over the same period. The head start nearly matches the superior strategy. And in many scenarios, the head start wins outright. 2 years of action at 8% beats 2 years of research followed by action at 9%. Perfectionism doesn't just feel like progress. It actively masquerades as progress while costing you real money. Now let me show you the math, because the numbers are what make this viscerally real. Let's use a simple example. $500 per month at 8% average annual returns. Person A starts at age 22. Person B starts at age 27, 5 years later. Person C starts at age 32, 10 years later. All three invest until age 60. Person A started at 22, invested for 38 years, approximately $1,316,000. Person B started at 27, invested for 33 years, approximately $870,000. Person C started at 32, invested for 28 years, approximately $568,000. Person A has $446,000 more than person B and $748,000 more than person C. Same monthly contribution, same return. The only difference is when they started. Person C's 10 years of procrastination cost them $750,000. And here's the number that really hits. Person A contributed $228,000 total, $500 times 38 years. Their returns generated $1,088,000, or roughly 83% of their final portfolio. Person C contributed $168,000, $500 times 28 years. Their returns generated $400,000, or about 70% of their final portfolio. Same investment. But person A's money had 10 more years to compound, which added $688,000 in returns. Those 10 years of additional compounding, the years person C spent procrastinating, were worth 4 times more than person C's entire lifetime of contributions. That's the cost, not of bad spending, not of debt, not of low income, of waiting. And this is the part most people miss. The person who defeats financial procrastination doesn't become a different person. They don't develop supernatural discipline. They don't suddenly understand the stock market. They do one thing. They set up an automated transfer to an investment account. One time. 15 minutes. And then they never have to make the decision again because the system makes it for them. Automation is the only reliable cure for financial procrastination because it removes the decision from the process. Every month, the money moves from checking to investments without your involvement, without your awareness, and critically, without your brain having an opportunity to procrastinate. You can't delay a decision that's already been made. You can't postpone an action that's already automated. The identity shift is real. The moment you automate your first investment, you transition from someone who plans to invest to someone who invests. That identity change from intender to actor is permanent, and it reframes every future financial decision. Because once you're someone who invests, the question changes from, should I invest, which can always be delayed, to, am I investing enough, which assumes action and optimizes from there. The shift from contemplation to optimization is the shift from procrastination to progress. You're probably wondering what the practical effect of defeating procrastination looks like in real life. Year 1, you automated $500 per month. You have about $6,300 invested. It doesn't feel like much, but the conveyor belt is running. The compounding has started. And for the first time, you check your account and see a number that isn't your contribution. It's a return. Maybe $180. Small, but it's the first proof that your money is working. That proof is more valuable than the $180. Year 3, you have about $21,000. The returns are now about $150 per month. An invisible contributor that shows up every quarter. You've survived a market dip. Your balance dropped 8% and came back. You didn't panic because you didn't have to decide anything. The automation continued through the dip and bought shares at lower prices. The system protected you from your own psychology. Year 5, you have about $39,500. Your returns this year were roughly $2,900, almost half a month's salary. Your money earned nearly half a month's worth of work for you. The relationship between you and your money has fundamentally shifted. You're not just saving. You're building something that works independently. Year 10, you have approximately $97,000. Your annual returns are roughly $7,500, more than $600 per month. Your money is now earning more than your monthly contribution. It crossed the threshold where the system generates more than you feed it. That crossover would never have happened if the belt wasn't running, and every year going forward, the gap between what you contribute and what your money earns widens further in your favor. And the career effects of defeating procrastination extend far beyond the portfolio. People who have been investing for even 2 or 3 years carry themselves differently. They have a financial foundation, however small, that changes their risk calculus. They negotiate raises more aggressively because their finances aren't purely dependent on the outcome. They pursue promotions more confidently because a temporary setback won't break them. And they make career moves with a 3 to 5 year horizon because their investment timeline has taught them to think in those terms. The person who procrastinated for 5 years doesn't just lose $446,000 in potential wealth. They lose 5 years of the confidence, security, and strategic thinking that comes from having money working for them. The procrastination cost isn't just financial, it's behavioral, emotional, and professional. Here's a concrete example. 2 people both earned $60,000 at age 27. Person A started investing at 22 and has $39,000 in investments. Person B has been procrastinating since 22 and has $2,000 in a savings account. Both are offered a new role at a startup. Higher risk, higher reward, 15% equity upside, but 10% lower base salary. Person A takes the risk because $39,000 in investments provides a safety net. The startup succeeds and the equity is worth $80,000 3 years later. Person B passes on the opportunity because they can't afford the pay cut without savings. Same talent, same opportunity, different outcome. entirely determined by whether the conveyor belt was running or sitting idle. Now, I need to warn you about the way procrastination disguises itself after you've defeated it once. You set up the automation. You're investing $500 per month. Victory. But then a new form of procrastination appears. Optimization procrastination. I should increase my contribution, but I'll wait until after the holidays. I should rebalance my portfolio, but I'll do it next quarter. I should open a Roth IRA, but I need to research which one. Each delay is small, each feels reasonable, and each one costs thousands in the same invisible way that the original procrastination did. The fix is the same: automation and deadlines. When you get a raise, increase your automated contribution the same week. Set a calendar reminder to rebalance once a year. Schedule the Roth IRA opening for Saturday morning at 10 a.m. Give procrastination no gap to fill. And here's the most important reframe. You don't need to feel motivated to take financial action. You need to feel motivated for exactly 15 minutes, long enough to set up the automation. After that, motivation is irrelevant. The system runs whether you're motivated or not, whether you're tired or not, whether you remembered or not. The system doesn't procrastinate. And that's the whole point. So here's what I want you to do. Not this week, not this weekend, right now. Open your brokerage app or your employer's retirement portal. Set up an automatic contribution. Any amount, $100, $200, $500, whatever you can sustain. Pick a target date fund or a total stock market index fund and hit confirm. 15 minutes, one decision. And the conveyor belt starts running today, not someday. Every month from this point forward, your money will be working, compounding, building, not because you're disciplined, not because you're motivated, because you made one decision that runs forever. The number one wealth killer is the gap between knowing and doing. And the only thing standing in that gap is 15 minutes of action. Close the gap, start the belt, and let time do what time does. Turn small, consistent contributions into something extraordinary. Because the best time to start was years ago. But the second best time is the next 15 minutes. And 15 minutes from now, you could be someone who invests permanently, automatically, and irreversibly. That version of you is waiting. Go meet them.